Where is it? There it is. Okay. You should have a notice that now the recording has begun. Michael Blacklock, nice to see you. Thanks for joining. Okay, so officially it is August 8th. um, the window right between the two atomic bombs, which is kind of how it felt like in the market. August 6th and August 9th, 1945. I used that in one of the market desk notes. And this is the Market Structure Edge live demo and discussion. With me today is Brian Wilson, market strategist. And Brian and I and Henry share the duties in writing market desk notes, and we're all at your disposal to help you use the data effectively. You can send us all an email, tq@marketstructureedge.com. Brian is bw@marketstructureedge.com, and we'll always answer our emails. Might take us a little time. All right, so in the middle of all that's going on, this is a great time to have this discussion. And I've got things I will cover, and Brian Wilson is going to lead us off. And it's all about, what do you do to make sure to the best of your ability, avoid losing money and produce returns on your portfolio. Brian, over to you.
Well, thank you. Appreciate it, Tim. Good to see everyone today. As Tim mentioned, we are always available, for your questions. So happy to address those. I have 4 or 5 different topics today, and then Tim and I will probably share what we usually refer to as kind of the what's next topic. So I'll go ahead and get started. The document I'm going to show you here at the beginning is not an official document. Maybe someday in the future we'll be able to post it on our website, but it's just some thoughts right now. And here's what I mean. Just some different ways that you can think about the data. In other words, how can we use the data to the best of our ability? And we'll just kind of rapidly walk through some of these. Just think of it as food for thought. If some of them catch your attention and you want more details, about them, give me a holler. Happy to unpack them for you. Most of you are familiar with the daily trading ideas. Of course, you find that up at the top of your portfolio. You click in there and it'll give you the different ranges for those different ideas, different probabilities, etc. So most of you are well versed on those concepts. What about a concept that I call long-term positioning? So our market structure sentiment tool does provide predetermined levels where the broad market becomes a little bit stretched or overbought, and where the market becomes oversold. And let me show you what that looks like. Go back to your dashboard, and on your broad market sentiment, this is what I'm talking about. So when we hit the red line for sentiment, the whole market's becoming a little bit stretched. It becomes increasingly difficult for the market to continue to hold on to gains. Conversely, when we get to the green line with sentiment, the whole market becomes oversold, becomes a very good buying opportunity. So that's what I mean by the long-term positioning. Value investing, you can set up portfolios where you're capturing stocks that are just starting to rise from oversold conditions. Now, recognize that there you do have a little bit greater risk because some of those names might not ever get back to 5. So in other words, they might not have enough demand to ever be a good return or not. But you can set up value portfolios. You can short individual equities, and you can set up portfolios related to that. I have a couple of different ones that have different parameters. And as I mentioned in today's note, there's actually a lot of names right now from a shorting perspective. You can short the broad market. I mentioned that strategy today as well. You can do that through leveraged downside instruments. That's one way to do it. Of course, there's a lot of different ways that you can short the market, but it's just going long the market, but it's just going the opposite direction. And the last one, and this is not a very good name for it, but right now I'm just calling it big tech awareness, because as big tech goes, so goes the market. And let me show you what I mean by that statement. Let's go to our big tech portfolio for a second. and you can see the struggles that the market has had during the last couple of weeks when big tech has been languishing. So over here on the left is big tech that topped at 7.5 a couple of weeks ago. You can see it's been pretty much a straight ride down for tech, and we're just languishing right now. As of this morning, sentiment is 2.1. Short volumes are rising. It's just not. It's not a great setup. Meanwhile, look at what's happened to the SPY as demand has faltered for big tech, while the whole SPY, the whole market has come under tremendous pressure. Now, part of the reason for that is because of the tremendous weightings that big tech has. What you're looking at on your screen right now is just the SPY itself. It's a download that I did this morning. And take a peek at the top 14 names. So the top 14 are right here. They're everything that's 1% or greater in terms of weighting. So those top 14, about 38.5% as of today. And most of those names are the ones that you're very familiar with. That's why big tech matters. As big tech goes, so goes the market. And what we're trying to watch right now, we're obviously getting a little bit of a rally today, but you can see that this setup is still not great. If we ever get demand moving the right direction, there's a lot of potential upside here, but we're not seeing that presently. So that was the first two items I wanted to address. One was what I'm calling just basic investing techniques, using daily trading ideas. You can have long-term positioning, you can have value investing, you can short individual equities or the broad market. And that last one is what I'm calling big tech awareness. For the next area here, what I want to draw your attention to is just the context of the market and just a reminder of how you can find this information. So you can go to our website, just go under resources and go to the expirations calendar, and that will show you what's coming up for the month of August and really for all the months that you want to be aware of. What you want to specifically be aware of is the expirations time frame. It's very, very difficult. Markets can get extremely volatile during expirations itself. You can see that expirations is coming up next week, 15th and 16th for the market. What do you see in green here is volatility expirations. And then you come to the end of the month. This is end of month positioning coming up at the end of August. So yeah, just wanted to give you a reminder about context and also in regards to earnings. Some of you might be seeing good setups in the market, but if earnings is coming up, you just never know what bets are happening behind the scenes. As a general rule, I just try to stay away from earnings. You just don't know what hedge funds have been doing in terms of those bets. And you can just get easily burned. You can make money, sure, but you can easily lose 10 or 15% as well. Now, obviously, the markets have been very, very volatile recently. And when we look at some of this volatility that we're seeing in the markets, how can you trade the markets when they get that volatile? Well, here's a couple of ideas that have worked for me here in the past, and they've worked this week as well. Sometimes I will trade UVXY. So that's a volatility one that works well when the market goes down. If the market goes up, that does not work well. I think it's down like 10% today. For short-term trades, and I mentioned this one today, SPXU is a good one for shorting the S&P 500. Well, let me just give you both sides. SPXL would be the long side of that trade. SPXU is the short side. I will sometimes go with the tech trades, TQQQ or SQQQ, both sides of basically the triple Qs. And I'll sometimes also play the FANGs. FNGU or FNGD. All of those are leverage trades, but they're ways that you can take advantage of volatility in the market. And one way that I traded that yesterday, and I can turn off my uh, I can stop sharing for a second. One way that I traded it yesterday, and it worked for me when the market rolled over, and that was a good reminder for me today, is I bought at SPXU when the market started to roll over, and then I made 3% on it during the rest of the day. Well, I did buy SPXU today, but I never waited for the market to roll over. So, good lesson for me. It's just one of those days. The data right now does not support upside, but you sometimes it works against you. That's just the lesson of trading. You try to limit your losses. You try to be on the right side of the trade. I'll still be shorting the market, but lesson learned. Wait for it to roll over, but before going short the next time. So that was some of the things I wanted to cover, and we can kind of share the what's next here in a few minutes.
Okay, I guess that means it's my turn.
You're up.
Okay. Okay. Thank you very much, Brian. I appreciate that. And I traded the same way you did. And there are reasons why we do that. And Yakov, I will answer your question in this context. And for those who are very new to Market Structure Edge, I want to return to some basics. Everything that we do for a reason. We're not guessing at whether the market is going to rise or fall. And one day is not a pattern. There's a reason why the Dow, I'm looking over here now. I mean, it's come back quite a bit. I'm still down 1%, but I'm not really worried about that. That's well within the volatility range we would expect. I will explain what I mean. But the reason the Dow today, I'm looking over at CNBC, it could go up 700 points is because that is baked into the data set. The trailing data set and the volatility that manifests in it is what machines consume. It's very important to understand that the market is not driven by fundamentals. It's not a bunch of people sitting around studying the financial performance of stocks and making decisions. That is less than good. Glad to hear it, Pam. That is less than 10% of volume. So if you look at the market, you can put whatever terms you want to put it in. 1 out of 10 trades is going to be motivated by fundamental bottom-up behavior. And that behavior is losing money, not gaining it. Actively managed funds have had outflows of about $1 trillion a year for almost 15 years. I mean, it's staggering. It's why all the big money managers, from Capital Research to Invesco to T. Rowe Price, they've all had to get into the ETF business because that's where all the money goes. And that money isn't motivated by fundamentals. It isn't looking for outliers. It's motivated by the herd, beta, the performance of the market, the benchmark, and they've got capital to deploy following models. That's what they do. And then machines set the prices. Virtually the entire market is priced by machines because it's an electronic market, 100% electronic, all the same as 100% algorithmic, call it 98%. The market rules require prices to move very fluidly to the 16 different exchanges and 30 different alternative trading systems comprising the stock market, which is all in New Jersey. It's not in New York. It's in Mahwah, Carteret, and Secaucus, New Jersey, and it's a big data network. And the prices that are created change things, and it's baked into the data. Today, you could say, well, the jobs data came out. It's machine-readable data. When jobless claims come out, and machines were looking for a positive or negative number, and machines react to that outside market hours, electronic trading, and immediately the market moved. Now, was that a reasonable data point? It's not rational people doing those things, okay? Those are we always say there are two vital things to understand if you want to be successful as a trader, and it's not technicals and fundamentals. It is how the market works and what the money is doing. And we talk all the time about how the market works, and then we can always see using Edge what the money is doing. So the reason I have a short, and so look, there's a reason why the market is up, and I'll show you that too. Brian and I, we could decide. We're thinking people. We can decide what we're going to do, with regard to the positions that we take. But here's, why would the market be up? Well, there are 21 the momentum portfolio today. There is an uptick. You say, how is it possible that demand is rising? It may be very fleeting. I don't know what effect today will have on the data set. I am very aware of the supply-demand balance in the market, and it's not great. But you look at this green line. So if you're new to Edge, there are two core things we look at, and volatility. There is demand, supply, and volatility. Demand is an algorithm, the green part of the graph. And this is for 500 stocks, so it's going to be between 4 and 6 most of the time. It's an algorithm that meters what we call 605, 606, 607. If you use a retail brokerage, they have to report to you whether they receive payment for order flow. We're measuring how trades are handled, routed, and executed. That's what we do. And supply is short volume, not short interest. Short volume there are really no, we could call them wholesale brokerages now. Yes, wholesalers buy retail order flow. Robinhood sells all of its 60% of its order flow it sells to Virtu. The balance it sells to Citadel, Jane Street, Susquehanna, and Two Sigma. 100% of their order flow. Same with Schwab. You can look this stuff up. They're selling to machines that buy those orders. That's how we get to trade for free. But what I mean by wholesalers are big brokerages that carry inventory. That model does not exist anymore. So where does the supply come from for your trade to get filled all the time? Short volume, manufactured liquidity. Okay, so we look at that relationship. Is demand falling and supply rising? Well, probably not going to be good. As a general rule, that applies in any economic environment, an economy, retail stores, the stock market. Falling demand and rising supply tends to pressure prices. There are always some exceptions if there can be outliers. But this is why stocks are up today. There are demand's actually ticking up a little bit. It could be done tomorrow. I don't know. We will see. But supply is rising too, and that will undermine the upside. So if you have a very strong day, this today is a product of this, the volatility here, the volatility here, the volatility here, here, basically 20 days. I mean, there's the whole long data set, but machines act in very short increments. And that's the data they're going to consume, and they're going to input into the market the probability a price could move that much. It's not rational behavior. Rational money is not piling into the market. It's actually in the data doing the opposite. Yesterday was the first day where there was measurable selling by investors. We can measure all that. We don't put it all on here because, you can get lost in data. We want to keep it simple. So you'd look at this and say, well, I'm taking a chance if I short the market today. And I'm not shorting it just randomly. I'm only going to short it if it's essentially up all of its intraday volatility. That's very important. So when the market was up close to 2.5%, not quite, but close to it, well, that's nearly all of the volatility on a long run basis in the S&P 500. It's a little higher now, so you have those built-in data points that could move the market more, and it did. But that is why, and it's easy to understand that volatility will be baked into the data, and and machines will move prices more dramatically until we either have an entry point, as Brian said. It's just a statistical measure, but we find it very consistently true that when demand drops below 4.0, that is an entry point. We have not had that. And so I'm concerned about that. So these are the basics. Now I want to just cover a couple of highlights about what to do. And Yakov, here's how you know when to short. So number one, I'm going to look at broad sentiment. If it's deteriorating and supply is rising, I know we are in a period where we could short, and I have. They're absolutely, this is month-end options expirations. We had one strong day, and then the market falls apart. It's always a little dicey around options expirations. But in here, I know we are in a period where there are opportunities to short. They only come along, really, 3 or 4 times at most a year. where you can do it with confidence and you could make some big returns. I modeled some data for an Interactive Brokers webinar that really was going to occur yesterday, and they hadn't done enough. And they said, we just haven't gotten it publicized. So I said, let's move it to September. So going to do it September 10th. But modeling the data, just running a low volatility portfolio produced a return through about July 30 of about 18%, close to the S&P 500. But if you sit out during periods where we're over the red line and you short when demand is falling and supply is rising, it bumped the returns to 39% because you can really juice your returns with very careful shorting. It's not something, to me, and there are exceptions. Barry Norton here, and there are others who are very good at shorting. They can make this work better than I can. For me, I short the market only when the data tell me I have a very high opportunity to make a return. And so, Yakov, I'm going to expand this out and show you what I mean. Let's go year to date. So anytime where demand has peaked and it begins to fall, so it hits the red line, begins to fall, and supply rises, well, there's a short opportunity. There's one. We got one in May, right after options expirations, very brief, and it didn't last, right? It almost immediately, the supply side stopped rising and began to deteriorate. Now you got to get out of the way. And now we have one here. There are not really any others. Those are it. So this is the third time this year, and only two of these were really meaningful. And how do we know that this isn't going to work itself out and the short opportunity is gone? Well, we don't, do we? But I'm going to take you to the last part that I want to show you. I always look at what the money is doing. So going over here to the dashboard, that we put 13, I think it's 13 portfolios by default on your dashboard. Then you can create whatever you want. I've created a mega caps portfolio because this is 75% of market cap. And so if supply is rising and demand is falling and even beginning to tail below 5, unless there's some very big change to that, it means that 75% of the market cap is negatively disposed. Well, there's one thing that gets my attention. As Brian said, big tech. What about this justifies a 500-point move in the NASDAQ? Nothing. Ergo, it is not fundamental. But what will happen is machines which know that people started selling yesterday, they can figure it out just like we can. We use math and algorithms, and so we can like, ooh, we had some sellers. It was actually the worst day yesterday of this entire correction if you look at the amount of buying versus selling, which we do with an algorithm. So machines know that, and they run the price up because they get human beings who are reactive and emotional to go, well, maybe I'm missing out on the bottom, and chase the price of wham. I mean, I look at this, I would not want to be long the market here because I can look over my entire dashboard and look at outside of momentum. There's your only divergence. You got 21 stocks, healthcare leads, fast trade. Machines are responsible. And they are responsible for most of it, but there's rising demand, falling supply. That can produce gains. But again, broad market sentiment has to be moving in the same direction for that to consistently work. It is right now, but you need to do that very short term. I don't like these conditions for being long stocks. So now let's just look at the whole dashboard. AI, have a little AI portfolio. Terrible. But demand is at 1 and supply is rising. Now the 30-day trend is down, but the short-term trend is back up. Airlines and cruise ships, terrible, right? Communication services, terrible. Consumer discretionary, terrible, terrible. Crypto, terrible. Dow Jones, it's not terrible, but it's not great. It's 50% short and demand is falling. Financials, no good. Look at that. Falling demand, rising supply. Big financials, well, they have a little covering. These could be closer to a bottom. Energy, no good. Gold looks okay. See that? Demand's rising, supply's falling. Maybe we buy gold. Healthcare, no good. Home builders, no good. Industrials, no. Tech, no. Tech is the entire market. Right, so I could go all the way through this, and what would I conclude? Small caps, lousy. You don't want to be in small caps. Semiconductors. No, now, the 30-day trend is down, but there's no demand and supply ticked up yesterday. Utilities, Well, they got better demand than the entire market, but supply is very high too. This is a long short trade. Hedge funds are trying to pick up a little yield and maybe some income. I look at that entire market and say, unless that changes, this market is going down. So then if the market is up all its volatility, 2.5%, let's call it, just generally, uh, I'm going to be short that, and I am. Now I could be wrong, but the data are clearly all on my side. Again, there are always outliers and edge cases. This might be one, but I doubt it. The probabilities are on my side. And then there's this. This is SPY. SPY is a great proxy for the S&P 500, and you can look it up on Edge. It's the only ETF on the platform. It's not, you can't put it in a portfolio because it's not in any sector. We had to override some features to include it, but I thought it was important to have this benchmark. And so look at this. Demand fell below 5. It's not happening in the underlying stocks, it's happening in the ETF. The supply side, while the trend has been down, and it's a very long-term trend, the supply side is also generally up. It's about the same as in the underlying stocks. I said way back in, I'm going to expand this out a ways, in April. So, generally, when demand breaks below 5, there are two events, not always. And you could, when I say is here's an event and here's an event, here's an event and here's an event, and then it ends, and then we're off to the races. And we've had an event here, and I said, well, logically, we would have another. We had a tiny little one. So is this shoe number 2? Well, I don't know, but it's what has historically happened. Here's another interesting thing. It began in November of 21 with an extreme spike in short volume, and it concluded with an extreme spike in short volume in September of 22. This was a terrible time for equities. We had a bear market. S&P 500 was down 20%. Then that all went away. Now we have a big spike, and you could go right here, really short one. Big spike, cover, big spike, and it was over. Of course, this was a monetary policy change, end of rate hikes. So is this the beginning of another cycle? I don't know, but I look at it and say, well, it's possible. It's possible. This is I'm not gambling. I'm looking at, I want as many data points to support a thesis as possible. And it all comes back to supply and demand. So I look at this and say, now maybe it all works out. But I think we could take another 10% down or more. Just looking at all the data points, and again, I don't know what's going to happen, but we can see what all of the money is doing. How does the stock market work? We know how prices are set. We know about volatility. What is the money doing? I just showed you. You can see it. It's a beautiful thing to be able to see what everybody else is doing, and they don't know that you can see all of that. So where I arrive, and Brian, you and I can wrap this up now, in looking at what's next, is I'm pretty happy being short, and I might even hold it overnight. I don't do that often, but this could be a longer term short. I don't know. It's a risky endeavor from the standpoint that we don't absolutely know what's going to happen, but we certainly can understand the probabilities. A strong day could change outcomes. It's also possible we give back all the gains in the final hour. The final hour is where all the reference prices are. And I don't know where those are going to be for the end of the day. Looking ahead, I think conditions warrant, careful risk management and expect probable downside, and then we'll see. Brian, what do you think?
Yeah, before I get to mine, Tim, a couple of quick questions. One from MH having to do with smoothing. He asked whether, or she, sorry, asked whether smoothing might be applied to charts. What is the smoothing? Smoothing, is it, weighted moving average? What's the period?
Yeah, we apply a number of smoothing techniques to both sides of the supply demand equation. So we apply a rolling 5-day average to the demand side. You might say, well, why 5 days? Because when we studied patterns, we studied all ranges of patterns, and what we found is all the patterns of the movement of money showed up in 5 days. And I think it's how big institutions using algo wheels, scheduled algorithms move things. There's no liquidity in the market. The average trade size is 99 shares. The average S&P 500 component trades 70,000 times a day in tiny little increments. You can't move a big position, and you're trying to hide it anyway, because if you don't, somebody front runs you and the market tips over on you. So that has been very effective. Then we apply smoothing techniques to the short side, the supply side as well. It's very, very lumpy data, and look how lumpy it is anyway. Because a broker could mark 100% of its flow for a day short because it doesn't know, because all the trades are electronic. And so to not get sidewise, regulators let market makers naked short. It's because they're supporting a continuous auction market. So we absolutely do apply smoothing techniques. Could we improve that? Well, to me, the problem with moving averages is they're so smoothed, they're not leading indicators, they're lagging indicators, which are consequences. I don't find that moving averages offer you any kind of benefit. The range is too wide. These do. These help us know that in 5 days or less, something's going to happen. But it's a good observation.
Thank you. The other question had to do with Apple, just what we think the setup is right now for Apple trading.
So you could do this with any stock, right? And how do we look at this? Well, it's not very good. Here's where Apple had great opportunity to produce returns for you. Demand rose, it was at 5 and it rose, and supply dipped sharply to start July. Well, that's how you get a run. And then when do you leave? Well, when supply rises or demand falls. So anywhere in here, you could have left here and you still have captured all the gains. You might miss 1 day or 2 days of gains. You could wait all the way to demand declining, but now you're down even more. So I look at the supply side, say, once it's rising and it's over the trend, you're out. And I look at it now, weak demand. Supply is not bad. I mean, it's well below what's in the S&P 500, but it clearly isn't trending in the right direction. I wouldn't look at this. Can you hold it in a long-term portfolio? Fine. But, I say own stuff when it's over 5. And this is very true for Apple too. If we profile it in the trailing 90 days, just to look at how we only profile the demand side, how did it do? Well, you could produce, if you owned it only when it was above 5 and you sold it when it returned there, you could make 22%, right? And if you bought and hold it, you make 23. But here's the deal. You only had to own it 52 days to get all of that return. Well, why wouldn't you do that? Because the other 48 days or whatever the spread is there, 38 days, you could go do something else with that money. That's the power of using supply and demand to help you know when to own things. And if you look at Apple right now, not where you want to own it, to me. Those conditions can change. Here's to Brian's point about earnings, let me throw this in. Shopify. I mean, could you know that Shopify was going to shoot up 20%? Well, of course not. You look at the supply side and it's terrible, but there were big, long bets set at July options expirations. That's a ways out. That's a pretty big gamble. You can commit your capital for 3 weeks. But, this is why, how would you know? And it's the unreliability of any data set, any model about what a stock might do. Now, we could model that Shopify could get to 67. We do that kind of stuff. And son of a gun, it did. Intraday, it got to 66.90. But it's very dicey. That's why we say just avoid that.
Yeah.
Okay.
And I'll share one thing here in terms of just looking at the path ahead or possible path ahead. And I believe I shared this in the note this morning. So let me go back for a second. So what I wanted to point out was April trading, and let me back this up a little bit. So when we look at broad market sentiment, where we're at right now, 5.4, decent number. Where do we go from here, right? What's next? And I was looking at April. April timeframe had very high short volumes. You can see that we were well above trend. The difference between, and you can see we're above trend right now as well. The difference between April and now is the fact that broad market sentiment actually went below the green line at that point in time, and we were able to rally from oversold conditions. Well, if we move lower from a sentiment basis right now, we actually have a little ways to go to get down to oversold conditions. That's part of what got me a little bit worried when I was looking at the data this morning. That if sentiment does fall, we could potentially be lower, maybe into expirations next week. I don't know, and I don't know if sentiment will recede from these levels or not. But if it does, we have some potential downside to go even after these declines. We could have further to go to actually get down to oversold conditions. So that's part of what brought out the bear in me this morning, I think.
Yeah, and I agree. And you could, uh, the counter argument that you might be thinking is, well, how do you know it's not a bottom? I mean, what if the supply side suddenly falls and demand increases? Couldn't that be a bottom? Well, yeah, it could be. It just is not usually where it happens. I mean, statistically, 100% of the time, even if it's quite short, when demand drops below 4.0, it has been a bottom in the entire data set. You can go look at it yourself. Go find those. You can go do that. And so we're not there. I don't know. Maybe some data point comes out that changes all the macro risk management systems, like BlackRock's Aladdin system that governs risk for $20 trillion of assets, and some data input changes that model. What could happen? I don't know. But statistically, these conditions tend to produce more downside. We'll find out, won't we? I think that is all I've got. And it's in mountain time, it's 109. That's plenty long enough. Hey, Steve Hicks.
Yep.
Yeah, please.
Got a quick question.
Yes, sir.
When we talk historical of things not happening, at what point did the majority of trading go to machine trading? At what time period?
Well, the big shift was 2007 with the implementation of regulation national market system. That didn't lead to, order management and execution management with algorithms, but it meant that a basic order, a marketable trade in particular. So if you put in a market order, you choose market instead of limit, or if you set your limit order in between the bid and the offer, the spread, that trade as of 2007 by law had to be automated. Because how do you know where the best price is? It had to flow automatically. So if you're executing a trade, say you're at Interactive Brokers, and you put that trade in, they have multiple choices. They have, could we match it? Could we internalize that trade? Could we send it to Credit Suisse's dark pool? Do we have to send it to an exchange and pay an access fee? That's the last place they want to go, because they have to pay a fee, right? Or potentially, they might earn a credit too. But that's when it happened. Now, between then and so there was a huge explosion of high frequency trading. We called it coupon cashing, where high frequency traders learned, oh, we could take we could take an order to create liquidity, a sell order, and get paid for it. And it became 75% of volume. And that's how Getco, which became now Virtu, made a huge amount of money. And both those guys, the founders of those firms, own sports teams. Well, that's where it started. So now it's much more competitive, but nearly everything is a scheduled algorithm because you don't know where the liquidity is, and it's impossible to understand where the tick's going. Everybody else understands that, but retail traders. You can't know where the tick's going to go intraday. It's because Citadel knows, but we don't. So we have to take a long step back, but it's been that long, and I don't know exactly at what, where the tipping point came, where all of a sudden it's just everywhere, but it has happened within the last, call it 7 years.
Okay, so when you go back, I guess historically, you're not able to go back to where 7 years ago because you haven't been doing this for 7 years.
We can go back 7 years, and I think pretty close to that. 27. So we could only launch this platform when exchanges started to sell data that we could use. So when we were serving public companies, which we started to do in 2005, right as Reg NMS was being created, it was about to change the entire market into a market-making model, which meant that we could measure both sides of the trade and all the volume. You can't in a specialist system because there's a book of business and all you see is wherever they got, midpointed. That whole system went away. The DMMs, the designated market makers on the floor of the NYSE, are not specialists. They're proprietary traders, and they're paid to be 10% of the volume at the floor. And the floor is only 9% of the volume anyway. So they're 1% of volume, but they get paid for that because they are the ones who open the prices. The NASDAQ is all market making. So from 2005 to 2017, we had to get permission from public companies to apply analytics to their data, and the exchanges hated us for it because we were showing them how all of their volume was high frequency trading, and the NASDAQ didn't want us to do that. I had the general counsel scream at me, and I said, you know where I am, come sue me. And they never did. So then in 2017 we picked up a data set and we went, that data set might work, and we tested it for 18 months and we picked up another one and now we can create a platform. And that's why Edge exists. It's because the exchanges sell data to help brokers comply with the rules, and we applied the analytics that we spent from 2005 to 2017 developing to that data. And we've watched the transformation, Steve. We watched, the amount of parties making markets and executing trades and clearing them go from hundreds to like 8. I mean, there are 15 firms executing all the trades now. It's crazy. You did not need that market structure lesson, but we know a lot about this stuff. This is this is our forte, and we've studied it a lot.
Thank you.
You betcha. Good. Yeah, I know. I don't know if it's worth the thanks or not. But
that was a head full.
All right, you guys. Steve, it's great to hear you. Thank you. And thanks for being here, everybody. We'll do it. Well, I'll be out next week and the week after that. I'm off to Italy to attend the Palio, this horse race in the Piazza in Siena, because a friend said, hey, I've got tickets. You want to come? And we said, yes. So I've got to put on the Palio pants and I'll report in from there. And meanwhile, Brian and Henry will take care of you. I'll see you, I think it's the week of the 26th.